Hello, everybody. My name is Eric LaRose. Welcome today to Planning for 2024. So where do you see your company in 5 years? It's a stock question, but it's an important one. Many of us are busy creating short-term plans, our weekly task strategies, our monthly budget reports, our year sales forecasts, and so on. And we forget that long-term planning is just as important when it comes to setting financial goals and creating growth opportunities. So with that in mind, from a dollars and cents perspective, where do you see your company in 5 years? That's the subject of today's webinar, Planning for 2024. Led by VX Group President Eric Zaromsky, we'll have a discussion on how to create a 5-year plan for your organization that diversifies a client base, sets your yearly measurable benchmarks, and creates the right kind of revenue growth for your company. Now, before we get started, this is a discussion, and you are invited to ask questions using the Q&A button. Click it, submit your questions, and we'll get to as many of them as we can at the end of today's webinar. A lot of people also like to use the chat button, which, we'll tolerate because we want you to ask that question. But if you could use the Q&A question button, it is a little easier. All right, so let's get started. Allow me to introduce our president, Eric Zaromsky. Eric, how are you doing today?
I'm doing just fine, Eric. There's multiple Erics on the phone or on the line
Yes.
today.
Well, you can't have too many Erics. That's what we always say. So planning for 2024. Let's how would you walk us through this here? What do you thought?
Well, let's get things rolling. So thanks for the overview and the introduction, Eric.
Mm-hmm.
As Eric mentioned, I'm Eric Zaromsky. I'm president of the VX Group. I wake up every morning with a focus on helping companies drive profitable top-line revenue growth. At the VX Group, it's our belief that when companies are growing, good things are happening. We get to throw holiday parties, we get to give bonuses, we get to redo our offices, hire staff, all of those great things. And when companies aren't growing, a lot of the other things, the inverse happen. And I think probably everybody on the line has experienced both sides of the coin. And I'm guessing that you're with us and that when companies are growing, good things are happening. So as we've kind of led off a number of our webinars with kind of the same concept around, have you said or heard? Because we hear and sometimes say a lot of things about growth and about business. So our statements for today are, we need to grow the business. Usually said by the owner or the president, usually said in December, usually after numbers have been missed and people are scrambling to hit goals and keep the business in line both from a revenue and a profitability perspective. We'll also hear we should be an XX million dollar company. Somebody who's 5 million feels they should be 50. Somebody who's 10 thinks they should be 100. But not a lot of detail is put into those statements when they're made. Sometimes there's some fist pumping and table pounding that says this year has to be better than last. We've got to do better. Well, what does better mean? And then there's kind of an old adage of if we're not growing, we're dying. And in many cases that's true, but it still doesn't tell you what you're really trying to achieve as a business. So all of these statements are very general, and the question is, what does it mean? When you say something like we need to grow and pound the table, what does that mean to you? What does that mean to your team? What does it enable you to do as a business owner or a business leader? What does it do to inspire and motivate your team to drive growth of the business? So we're going to start just by touching on a couple of pretty basic objectives around planning for the future and around goal setting. Some of you may be familiar with what I'm going to talk about. To others, it may be something completely new. But I do think it's important to have a refresher of some of the basics of goal setting and just straight up planning for the future of your business. At a very basic level, we'll talk about goal setting as setting SMART objectives. I'm sure some of you have heard of this before, but in our minds, SMART objectives are specific. We need to grow, it's not specific. Measurable, attainable. It's got to be something that's attainable. That doesn't mean that it can't be a stretch goal or a stretch objective, but it's got to be realistic. To be a $5 million company and say you want to be a $500 million company, in 2 years is probably not a realistic, attainable objective. It needs to be relevant. It needs to be relevant to the business. It needs to be relevant to the business owner. It needs to be relevant to the people that you're going to be working to inspire and motivate to achieve your goals and objectives. And it needs to be time bound. It needs to have, an end date to it. All of those components make up, a SMART objective, and one that you can really use to drive the planning of your business and drive, the future of your business as well. So if you look at, our before statement from a few slides ago, we talked about the fact that we need to grow the business. Not a very specific objective, not measurable, not probably attainable. It's certainly relevant, but it's not time bound. But if you look at that simple statement and switch it up and say something like, we need to grow our revenue from 5 million in 2018 to 15 million in 2024. It's specific, it's measurable, depending on the business, hopefully it's attainable. It's certainly, relevant to at least the business owner and the business leadership and those that are going to directly benefit from growth of the business. And it's time bound. We've given a start date and an end date, and it's really, would fall into the category of a SMART objective and one that's going to help us anchor and focus the organization on where we want to take it as a business. SMART objectives have a purpose, and the purpose is to provide clarity to the ownership of the business, to the leadership of the business, and to the team that we're going to be working with that's going to help us get from point A to point B by some point of time in the future. Most of the business leaders that we work with, one of their largest challenges is providing clarity first to themselves. We work with a lot of business leaders who don't know what their end game is. Is their end game to grow the business and sell it? Is their end game to turn it into an ESOP or an employee or an owned organization? Is their end game to simply retire and fade off the business off into the sunset? A lot of people, a lot of business owners don't spend much time thinking about what's the end game. And that's a really important part of providing clarity in their own mind. And setting SMART objectives helps you find your way there. So, I probably said the word growth 20 or 30 times already in this 10 minutes that we're into our session today. One of the big questions is, why grow? Maybe we should just keep the business the way it is. What's the purpose for growing? What's the benefit to growth to the business owner, to the team, to the other leaders? Why do you want to grow a business? The reality is, in the real world, that size matters. And it matters a lot when it comes to determining the value of a business. And I wanted to touch on this because, as one of our team members said earlier, a lot of companies don't think about their business from a valuation and value perspective. That's 5 years, 10 years, 15 years down the road. And they figure that when they get there, they will have built something valuable. But if you don't know where you're going, it's really hard to figure out how you're going to get there. And when it relates to the value of a business, buyers put a heavy weight on company size. And it's usually measured by an average revenue over the past 3 to 5 years, or what I might call a rolling run rate. So basically taking, the last 5 years and working your way forward, dropping the oldest and pulling the new forward to determine a revenue, an average revenue of the business over 3 to 5 years of history. And there are some natural inflection points from a value perspective. Companies less than $5 million are generally valued less than a company that's going to be in the $5 to $12 million range. Similarly, 5 to 12 is going to be valued less than 12 to 25, 25 plus. We're talking about kind of mid-market, mid-sized businesses at this point. But throughout the spectrum, whether you're a $5 million company or a $5 billion company, clearly the size of the business is going to impact the value of the business and impact what's called, a valuation multiple. So basically when a buyer is valuing a company, they're looking at the average sales over the past 3 to 5 years. They're determining, what the pre-tax profit is. So looking at, average sales, average margin, what's your pre-tax profit before that or after that, and then applying some type of multiple of pre-tax profit to determine valuation. So to kind of illustrate the point that I was talking about earlier, if you've got a $3 million company at a 10% margin, so we're kind of assuming that all of these companies are generally the same, they're just some are bigger than others. 10% margins generating a pre-tax profit of $300,000. You're probably going to have a multiple in the 2 to 3, maybe 4 range, which puts the business value at $750,000 approximately, if you take the average of those two, and you get kind of a value of a percentage of revenue of 25%. So $3 million business worth $750,000, 25% of revenue. Let's look at just the other end of the spectrum to kind of show you what the contrast is. If you were to add, $15 million worth of revenue to that business over a period of time, same profit margin, it's now throwing off, nearly $2 million a year in pre-tax profit. Your multiple is going to be higher. A 2 becomes a 4, a 3 becomes a 6. The business is now probably worth somewhere in the $9 million range, and as a percentage of revenue, sorry, we clicked forward somewhere. As a percentage of revenue, we're now recouping 50% of our revenue as projected value in the business, as opposed to 25% up above. So why is a bigger business going to have a higher multiple than a smaller business? It's really a matter of how the buyers perceive risk. Basically, the larger the company, the lower the risk is from a future cash flow perspective. So, if all things are equal, size matters in valuation, and it's really going to appear in this multiple area. The bigger the company, the lower the risk from a cash flow perspective, the larger pre-tax profit that it's throwing off, the more valuable it is to a buyer, and the more valuable it is to a seller. So from a purely dollars and cents perspective, growth is definitely a good thing for the owners, for the leadership, for those that are vested in the organization. And by growing a company, we can add significant value to its long-term value of the business. All right. So that all being said, I think we would probably all agree that growing a business is a good thing, and we all strive for that. And we all talk about it, but a lot of companies and a lot of people talk about it in pretty general terms. The core of what we're talking about today is how do we take these general statements? We need to grow the business. We need to do better than last year. We should be a $100 million company. Why aren't we a $100 million company? It is all noise until you start to break it down and turn it into something that, is actionable. So when it comes to growth, what does it take to make it happen? And I think that when you start to do this, you start to get a little bit more of a view of reality, and you start to really think about what needs to be done to make it happen. How to break it down into manageable chunks, and frankly, do you have the stomach for doing it? And if you don't, then you need to readjust your expectations till you get to a point where, as a business leader, you're comfortable in the investment that it's going to take to get the return that you want. So if we go back to this SMART objective that we outlined earlier, we wanted to grow our revenue from 5 million in 2018 to 15 million in 2023 while maintaining a 10% profit margin. And you've heard 2024, 2023. As we got into this, I realized my model or my sample and our title were a little bit out of whack, but we're going to talk 2018 to 2023. So you'll see that in greater detail as I move forward here just a little bit. So this SMART objective from 5 to 15 by 2023, specific, measurable. Is it attainable? That's the question that this is going to start to bring out. Relevant, yes. Time bound, yes. What's it going to take to do it, and what will be the potential future impact on the business and the future value of the business if we're able to grow it in the manner that is outlined in this SMART objective. So we've put together a little worksheet that I'm happy to share with those of you that are with us today. Eric will be sending out some information on how to access this workbook or worksheet. And we can also do one together if somebody wants to raise their hand and say, hey, throw my numbers in here. But let me walk you through how it works. So really what we're trying to do is a 5-year growth projection. And really one of the key takeaways from this is, what's it going to take for us to do that? So if we start with, on the left-hand side, I've got a couple of market segments here because a lot of businesses, they may have an automotive segment, they may have an aerospace segment, they may have agriculture, whatever it may be. But we do like to kind of break these segments down for a couple of reasons. One is it gives you a clearer view of your business. The other is it starts to unearth and uncover any concentration issues that you may have. If you're running a business and you're seeing 30, 40, 50, 60, 70% of your revenue coming from one customer or two customers, you really need to be looking at your concentration, and that by breaking it down into market segments, it helps identify those areas. This annual growth target is calculated, and this is a real number. So if a company wants to go from a total revenue of $5 million to $15 million over a period of 5 years, it's an annualized 25% year-over-year growth rate. I don't know about your businesses, but for many of the businesses we work with, that's a pretty big number. That's a pretty big jump in growth year over year. So the first thing that jumps out at me is that this is going to take some work to make this thing happen. Basically, what you do here is punch in your historic sales, or define your segments, punch in your historic sales, and then it works out where you need to be from a goal perspective. So over 5 years, we've got to add 1.25 million and so forth, and then my math, 1.6 and so forth, to get us to our just over $15 million in revenue. So over 5 years, we're adding, 10, $10.2 million to this business, or on an annualized rate, we've got to be growing this business by about $2 million a year in order to get to our $15 million revenue goal. And of course, we want to do all of that while maintaining a 10% profit margin. What this little worksheet also does is that if you establish a target EBITDA or earnings before interest, taxes, and depreciation, setting a target, setting a multiple that's realistic, it will run out what the value of the business is and how it changes over time. So in 2018, a $5 million business, 10% margin, with a multiple of 4 is going to give us about a $2 million valuation. There we go. As we work through, you see the value of the business climb to where in 2023, we're looking at about, a $5 million valuation at 15 million. So, adding on about $3 million in value to the business over this 5-year period. So you can see that having a structured growth plan, focusing it on, yes, growing top line revenue, maintaining, or in a perfect world, even better world, growing our target EBITDA, getting a maximum value can add, a significant amount of value to the business from a dollars and cents perspective. The worksheet also does some math for you on product line mix. So it will, look at what your market segments are and how you title them up here and determine what percentage or what ratios you've got in each category. Obviously, this is 50-50 because that's how I set up the sheet here. And then, I added a line around making it real. And maybe it's a little bit self-serving because, helping our companies and our clients grow is what we do. But people need to understand the kind of investment that it takes in, sales and marketing and other supporting activities around this to really drive, growth of company. Good, strong, business to business companies, which are the bread and butter of the clients we work with, really should be investing, somewhere in the neighborhood of 8 to 12% in their sales organization and their marketing efforts. I put this towards the high end because, frankly, a 25% year-over-year growth is pretty significant for any business, and so you're likely going to have to be at the higher end of that investment scale in order to make this thing real. And one of the things that so many business leaders do is they set, goals and stretch goals, but they're not really committed to making the investment that it takes to get there. And they don't necessarily have the inner strength to push through the investing part in order to see the returns that come out of that 6 months, 12 months, 18 months, 24 months down the road, 5 years down the road. So we really try and work on setting objectives that are realistic and attainable given the parameters of the business and, kind of the risk reward tolerance of the leadership. If somebody said to me and said, "You're crazy, we're not going to spend 12% of revenue on sales or marketing," then my response would be, then, we need to go back and adjust our goals because you're not going to grow at a 25% or 50% or 100% clip without making, an investment in the revenue generating engine of your business. So with that said, how do we turn insights into action? Number one is establish, a 5-year revenue and profit goal. You then want to establish what I would call a growth curve. And if we go back to the example here, I've leveled this out. So across this line is pretty much just 25% a year growth. And that's not really how this typically happens. In the first year, it may be 10, and then 15, then 20, and then 25, and then 30 or 40, because you've got to ramp it up. You may have really low sales numbers in a particular market segment, so this may be 100 or 200 or 500%, because you maybe did $100,000, but you think in 2019 you can do $500,000, and then maybe 700 and a million and so forth. So these numbers fluctuate. And that's really what I'm referring to when I talk about the idea of a growth curve. The next thing is to really break it down. We're talking about a 5-year financial window, but you're not going to create a 5-year plan. What you want to do is probably look at the next 6 months to 12 months, figure out what are you going to do to, reach the first year's goal. And then when you start to get into the start of the fourth quarter, hopefully, as opposed to the end of the fourth quarter of that year, you start to get your plan and your resources in place for the following year. So it becomes, kind of annual iterations of making it happen. But this growth plan provides the foundation and framework for what you're trying to accomplish. The fourth thing is do different. If you really want to grow your business and you're not growing, just doing more of what you're doing today isn't going to get you there. There are a lot of different ways to grow a business today. But like I said, if you're stuck, if you've plateaued, if you're growing at 2 or 3 or 5% and you want to grow at 20, you're going to have to do things differently than you've done them before. There's too many things that people still do today that simply don't work in today's selling environment and communications environment. The last thing is it's going to take, growth takes an investment in resources and dollars and share of mind. And you've got to carve out some time from worrying about the operations side of the business to invest into the growth side of the business. Measure everything that you're doing, learn from your activities, evolve your approach, and ultimately you're going to grow the business. So with that, we're starting to wrap things up, and next up, going to grab a couple of questions and hopefully answer them for you. But as always, definitely willing to help anybody who raises their hand and asks for it. I'd be happy to schedule some time, a one-on-one, to walk through the worksheet with you and help you think through it. Talk about how do you establish a good, solid growth model, and help you figure out how to make it real. As I mentioned earlier, Eric's going to send a follow-up email with a link to the worksheet. We'll also have a recording of this if you want to refer to it or share it with anyone. And then when we're ready to fire up a few questions. So, Eric, I don't know if anything's come in, but happy to do what we can.
Yeah, we definitely have a few questions here, but a reminder to everybody, if you would like to ask a question, there is a button that says Q&A. If you click it and just type in your question, it'll pop up right on my screen here, or if you do it through chat, we'll see those as well. Let's see here. So one thing that kind of came up here, you talked a little bit about valuation, Eric. And valuation, valuation isn't something I or anybody else in my organization generally look at. Am I alone in this, or is it a common practice to focus on that? That's the question.
I wouldn't say that you're alone,
Mm-hmm.
but you're fairly lonely. I think that business owners and business leaders look at valuation when they're tired and exhausted and go, I've got to figure out how to get out of this thing, and I need to find out, what it's worth in the marketplace, or the bank asks for it.
Right.
As I mentioned earlier, I don't think that Many businesses and business leaders spend much time thinking about, what's their end game? What's their, if you're a business owner, what's your exit strategy? I mean, I see a lot of, business owners in their 70s who still don't know what's next for them. And
Right.
while I applaud their desire and their commitment to nurturing what they've built, one of the most valuable pieces of advice I got when I started the VX group was from a good friend of mine who said, before day one, have some, vision of what your exit strategy is.
Right.
Because if you don't know where you're going, it's awfully hard to get there. If you went to Google Maps and all you could do was find a location, it wouldn't be very easy to find directions.
Right. Exactly. And valuation is definitely part of that map to success. Knowing that along the way, it allows you to be more proactive, I imagine.
Absolutely.
Okay. All right. So what happens if at year 2, we're talking about the 5-year plan here. What happens if at year 2 you aren't hitting your benchmarks?
Well, that's where I said you've got to have conviction and a willingness to stay committed to your goals. And over a period of 5 years, not everything is going to go perfectly. The line is not going to be a perfect growth path. From, in our case, $5 to $15 million. It's really, having a plan in place, having metrics in place, focusing on leading indicators so that you don't find yourself behind the curve, and then evolving the business in your approach over time. So if something's not working the way you want it to work, you want to pivot and go down another path. But you want to do that at the right time, when you've given it enough time to see if it's going to work, and early enough that you pivot before it causes you too much problem. And that's tough to do, and especially with manufacturing businesses and business to business sales. They often play out over periods of months or years. And so it does, you've got to have some leading indicators to hang your hat on, that if they're positive, it gives you the fortitude to march on.
Okay. All right. So you talk about, lengths of time here. Why stop at a 5-year plan? What about a 10-year plan or a 20-year plan?
Well, I think you can certainly do that. I think that 5 years is a good period of time. For those of us that have been in business for a while, it goes faster than you would think. And I don't think it's a bad idea to have benchmarks out that far. But when you get out to 10 years or 15 years or 20 years, I just think, the crystal ball is just way too fuzzy,
right,
to be able to track towards those types of objectives.
That's when you start getting answers from the magic 8 ball, like maybe?
Correct.
Yeah. All right. So I only have one more question on my list here, but there's plenty of time. If people have any questions, now is your last chance to ask them. We are not long-term planners. I think it would be a culture shock to start now. It seems that this is important. How do I address a shift in our culture?
Well, that's a loaded question.
It certainly is.
Well, yeah, I think it starts at the top. I mean, it's got to start with leadership. I'm guilty of it as anybody else, and struggle to find out to carve out the time, to truly lead the business and not get caught up in the day-to-day or, the hour by hour. I think that by simply starting this process, it begins to give clarity to your core leaders, and they understand what you're trying to accomplish, and that ultimately, that starts to have an impact on shifting the culture. Mm-hmm. And there will be people that willingly come along, and you need to embrace them and leverage them to help you grow that vision. There will be people that are resistant to change, or even and accountability. I don't even know that I find almost less of a resistance to change and more of a resistance to accountability these days.
Mm-hmm.
But you got to embrace the ones that jump on board, the ones that struggle to get there. You either have to kind of push them towards you or push them away, for lack of a better term. But culture change is hard, and I totally agree that A, you're not alone in not being focused on long-term planning. But B, if you jump in and start the process, the future leaders of your business, the people that are going to stand side by side with you, are going to rise to the top, and you're going to start to see that culture change happen simply by providing clarity to your team.
Okay. All right. Well, as you were answering that here, another question popped up, and it feels related. Is it important to have team employee buy-in? How do you get employee buy-in without them seeing profitability and wanting a bigger piece of the pie when they see actual money?
Mm-hmm. You have to figure out, what's there with them, or what's in it for me, and me being them. Because there are things in it for them. It may be money. But if you look at all this research, all the studies, all the McKinseys, all the Harvards, money falls down the list of priorities as it relates to, satisfaction from a job perspective. So you've got to figure out what's in it for them, whether it's, financial growth, whether it's career advancement, whether it's, some of the benefits that make your business a great place to work,
or that whole millennial
thing,
whatever
it may be.
Yeah, the whole millennial thing about just being part of a movement or part of something bigger.
Sure. Yeah, and finding that why, the why for your business, because they have to see something other than I'm just making more money for the owner.
Right.
So there's got to be more to it than that. And you've got to find your own level of comfort with transparency from a financial perspective. I've generally found that some transparency is great. Too much transparency can overwhelm people. Got to keep in mind that, if you're a business owner or a business leader, your depth of understanding of the business finances goes well beyond what most of your employees think about on a day-to-day perspective. So sitting there and talking about, gross profit and, SG&A and profitability and, all of those things can overwhelm people. But if you can figure out how to simplify it and share highlights, you can get more buy-in from your team.
Yeah. I've often been surprised that the term business translucency hasn't taken off, because you're absolutely right. If you get bogged down in all of the minutia of the day-to-day and in a totally transparent environment, it's just way too much.
Yeah. And it's the owner's job and leader's job to carry some of that baggage, for better or worse. It's our job to carry some of the emotion, to create an environment that people feel is, dynamic and, for lack of a better term, safe. But we, so we don't want to scare them, but we don't also want to, make them feel like they'll be, complacent. So there's like you said, a translucency somewhere in there. That's a little bit different for each business and each leader's personality and the personality of their team.
All right. Okay. Well, hey, thank you everybody for your questions. Great. And thank you for attending. Eric, thank you for sharing your knowledge with everybody today. It was truly awesome.
And I was gonna offer, Eric, I don't know if there's anybody on the call who wants to put some numbers into the worksheet now, but I do have it open, so if anybody wanted to raise their hand, I'd be happy to spend a few minutes just showing you a real-time example if somebody wanted to share kind of the basics of their business. So that offer's out there. We can leave it there for the 30 seconds that it takes for you to wrap up and see if anybody jumps in.
All right, sounds good. Okay, well, again, thank you everybody for attending today. If there are any takers on that, just let us know either through the chat or the Q&A. As Eric said earlier, we will be shooting you guys an email shortly with some information about the download as well as a link to this so that you can share it. We'll also keep you on our list for future webinars. We're doing these about once a month. We did pretty good with these last couple, with the holidays and all. We kept them almost on schedule.
And the snow.
Yeah, and the snow, yes. So with that said, thank you again for attending our webinar today. Looks like there aren't any takers, Eric. So you guys have a great day. Stay warm. And thank you again for attending.
Thanks, Eric.
Bye.